answering your tough financial questions for the past 26 years. It's Allworth's Money Matters with co-hosts Scott Hansen and Pat McClain. Would you like an opinion on a financial matter you're dealing with? Whether it's about retirement, investments, taxes, or 401ks, Scott Hansen and Pat McClain would like to help you by answering your call. To join Allworth's Money Matters, call now at 833-99-WORTH. That's 833-99-WORTH.
Welcome to Allworth's Money Matters. I'm Scott Hansen.
I'm Pat McClain.
Glad you are joining us today as we're talking about financial matters, investments, retirement planning, taxes, insurance, all those fun things. Both myself and my co-host are financial advisors and been doing this for 3 decades, doing this radio program for over 25 years. And
a long time.
Yeah, and certainly enjoy being here. And our objective is we are financial advisors, still practicing financial advisors. Our objective is to come to you with this program, whether you're listening via terrestrial radio or via podcast, and really be kind of your financial planner on the air. So another place to get some information. We're practicing advisors, and I think it's a little different than reading industry periodicals that are written by
journalists.
I mean, it's just different, particularly the longer you've been doing this.
Because humans are involved in decision making. And so, in fact, I read the...
And funny enough, we don't always make perfect decisions.
Oftentimes they're emotionally charged.
Or irrational.
Yes. Well, they don't seem irrational at the time.
I understand.
No, right?
I've made a lot of irrational decisions in my life.
Yeah.
And continue to do so sometimes.
You just try to hope that the rational ones... Everything seems rational at the time. You could backfill anything.
Well, you try to put some boundaries in your life in lots of different areas of your life. And in finance, it's one of those things as well. Like, what disciplines do you need to make sure you've got in place? All those sort of things.
Let's get the basics before we get rich.
Yeah. And so anyway, if you'd like to join us, we'd love to take your call and answer your question on the program. Our contact number to be part of Allworth's Money Matters, 833-99-WORTH, 833-99-WORTH, and numerically it's 833-999-6784. And love to take your...
Yes, and before we got on the air, I was telling Scott, we've been working remotely, our 50, 60, 70 employees remotely.
230 or 40 or something.
I'm sorry. I don't know what it is.
We're growing fast, so Pat just keeps adding. We must have another 20 people showing up somewhere.
But all over the United States, working remotely, and I got in my car today to come down, and we have a studio in our office there. We record this, and I'm thinking to myself, this is the furthest I have driven, and it was all 15 miles. This is the furthest I have driven in, I don't know how long.
Is that right? Really?
Yes. And I thought how enjoyable it actually was. As I'm driving to the office, I'm thinking, I'm really enjoying this drive to the office, and I'm thinking, remember that, because you're going to need it in the future
when the traffic's back.
Yes, you're gonna have to recall this day some point post pandemic that you actually enjoyed the drive to the office and seeing all your. Well, there's not many coworkers.
No, it's depressing coming in because it feels like the company blew apart.
Yeah, but there's this group. They're always here. There are 4 or 5 people
There's like 4 or 5 people that chose to come in the office during this time. We are an essential business.
Yes.
And
they're socially distanced.
Yeah, because there's 5 when there's normally 60 in this location. There's 5 now.
Yes. Yeah. So.
In any case, it's well, I tell you.
And those 5 people have decorated their cubes for Christmas. I was quite impressed. Did you look?
Yes, I saw that last time. I'm like, wow. And it was decorated for Halloween as well.
Yes. They're not going to take the spirit out of them. They're not.
Yeah, well, good for them, man. But we continue to march forward and hit new highs on the stock market. In the midst of this, if you look at and I know you've seen this, Pat, really the top 5 big tech companies that are driving a good chunk of this market.
Yes.
Their earnings a year ago, their price to earnings ratio, they're trading at roughly 19 or 20 times earnings of their previous year's earnings. Today they're trading at 29.
Because the price has gone up, but the earnings haven't kept up with the price increase.
The prices have gone up much faster than the earnings. So when people ask me, Scott, oh, you must feel great about this market. Anytime we see stock prices marching ahead faster than earnings, I don't like it.
And why is that, Scott? Because in fundamental investments, you're buying the earnings of the company. Many times what happens is that there has a tendency to get speculation in the marketplace where people are trying to buy future earnings or hoping that the stock price just continues to go up. But if the underlying earnings don't rise with the stock price, that's how bubbles are created.
And I've been doing this. We've both been doing this long. Parts of this feels a bit like 1999, and bit. It's the people that I know, sometimes not that well, that want to start telling me about all the stocks, the individual stocks, and they start touting that I bought this and I bought this here and I own Zoom and and you know the funny thing about it, it's kind of like when someone says to me how well they do at Las Vegas playing blackjack, right? And I know that, look, I understand the odds. Like eventually the house is going to win. So whatever you're telling me, it's either a bunch of BS or you just need a little more time. And I feel the same thing when people talk about individual stocks. Look, if the average actively managed mutual fund manager cannot outperform the market, matter of fact, studies have shown maybe only 20% of actively managed mutual funds can outperform the underlying indexes of which they're trying to invest. How is it that the individual investor that didn't get an MBA from the top business school, that
doesn't have a research department,
team, how are they going to make better decisions than those people?
Over long periods of time.
Over long periods of time. Short periods of time.
Yeah, long periods of time.
Like this guy was telling me the other day, and I said, I guess that's fine if it's just a portion of your play money, but I wouldn't have your serious money set up that way.
Well, I had a conversation with a person just this week, and they were talking about how their individual stock has done so much better than their municipal bond portfolio. And I said, it's not fair to compare those two because they're designed for two different things. And he said, why? And I said, well, because one is kind of like has very, very little risk, and the other has significant risk. So, anyway.
My sedan just drives so much different than my sports car.
Well, of course.
I mean,
I'm with you.
Well, I think it's one of these times, and I get a little concerned as a financial advisor. You look at the amount of options. If young people want to trade options all the time, eventually they're going to lose some money and they're going to learn from that. That's fine.
Yes.
Really, it's fine. My concern is you start seeing people that are in their 40s, 50s, 60s, have no experience doing things like that, are taking on way more risk. If you look at the amount of funds that have flown into like these leveraged ETFs and inverse ETFs, like these, the most riskiest of the risky type investments, money's flowing into those sort of, whether it's strategies or investments. And
quite frankly, it has become so easy to actually buy and trade, specifically, and especially now, options.
Yes.
Especially options. I have two of my four children trade options.
It's ironic, isn't it?
I don't get involved at all. When they ask me my opinion, I'm like, well, just don't play too much. And it's your money.
It's always times like this when it's like, you don't really understand. You're an old person. It's different this time. But we've seen enough market cycles. Look, and here's the thing.
Well, fortunately, my kids don't say that to me because they do know that I'm the co-CEO of a company that manages $10 billion, so they've never brought that up.
Okay, that's good. So hopefully you kind of think maybe you know what you're doing. Anyway, I just think it's important to remember, look, your own portfolio, understand what risk you have there.
It's risk-adjusted returns. Risk-adjusted returns.
And who cares what happened? What happened yesterday is irrelevant. Where you are today, your portfolio today, is it structured the way it needs to be structured for whatever your future income needs are going to be? If it's most likely retirement.
Yes. And the further you are in your savings and your life's journey, the closer you are into retirement, the more likely you should be concerned about not being poor versus being really rich based upon your investment portfolio, which means you better understand the risk.
Well, if you're 55 or 60, you're not rich yet at this point, whatever, how are you going to define that? Like,
You're probably not going to get
You probably
there.
have a different, I mean, maybe you should have a different goal at this point.
Yes. Yeah.
Whatever rich means.
Because
Because you talk to someone that most people would think rich and they don't feel rich because that guy, Bill Gates is rich. Jeff Bezos is rich. Anyway, let's take some calls here.
Who do you think Jeff Bezos says is rich?
His ex-wife.
Okay. That's pretty funny.
I don't know.
That's kind of funny.
I did find it. I mean, if there's certain people that I have tremendous respect for, Jeff Bezos, I mean, what he has created and continues to create, like, it's mind-boggling how they they go into these new industry after industry and just dominate. And he's now, as I think he hit the richest person in the world for all? He's right up number 2, whatever. He's super wealthy.
I don't know what it is.
But his marriage fell apart a year or two ago.
Yes.
And I thought,
That's
I mean, I just thought it was a tragedy because you're so gifted in this one area, but this other area that's obviously important to most people, sometimes more important in their career, that didn't work out so well for him. But
I haven't spent any time thinking about Jeff Bezos' wife or his ex-wife or his new girlfriend or anything. I was thinking about Amazon Web Services the other day.
We'll get to the calls.
I have wasted no energy, mind space, thinking about Jeff Bezos' personal life. But I was the other day thinking about how brilliant Amazon Web Services was, the cloud storage.
Yes, which is a much bigger part, at least the profits, bigger than their...
Yeah.
And also, I've got to confess, more retail stuff I'm trying to do directly with the manufacturers or different businesses.
Rather than through Amazon?
Yes. Because at some point, do I want any company controlling that much of my life?
Yes. I think I'm trying not to consume anything at all that
There we
requires
go. Be a minimalist.
And once I get everything I want, I'm going to become a minimalist.
Perfect. That's a great idea. All right, you tell me when that is. Let's take some calls. We're talking with John. John, you're with Scott Hansen, Pat McLean, Allworth Financial.
Hi, thanks for taking my call.
Thank you.
I've been listening for 20 years and always appreciate the way you both break down the various investment strategies for your audience.
Well, thank you kindly.
I have 2 questions that go hand in hand relating to after-tax allocations. My wife and I have approximately $400,000 saved up in various investment accounts, and about 20% of that is in after-tax, $457 in Roth. And so as I get near retirement, I'm trying to figure out what percentage I should be striving for in after-tax investments by retirement age. And then kind of along with that, my wife had an illness this year where she could not work, but she's fine now and is working this last quarter. She had some various previous 401ks totaling $36,000 that we rolled over into a traditional IRA a couple of years ago. So now the funds are in the total stock market index. But we thought this might be a good opportunity to do a Roth conversion on that $36,000.
How old are you?
Taxable income, 47.
What will your taxable income be this year?
Probably right around 105,000. Or actually, with hers, it'll be probably 130,000.
You're probably pushed into that 22% bracket. And are you a resident of California? I looked at your phone number here. It looks like you.
Yeah.
Yeah. So you're already in a pretty high tax bracket in California.
Do you think you're going to stay a resident of California in the foreseeable future?
Or retire in California?
I think so. I think we'll plan on retiring here also.
It's definitely something to take a look at. I don't know if your tax bracket is going to be any different in 2020 as it will be in 2021 because just the way the brackets work. But I would run the numbers.
Okay.
Yeah, you do a pro forma on your taxes.
Yeah.
Do you do your own taxes?
No, we have an accountant.
Okay, just
I
ask
call
them.
the accountant Monday morning and say, hey, here's what I'm thinking, or send them an email. her an email. Here's what I'm thinking about doing. What's this? What would it mean tax wise to me? What's the impact on my marginal tax rate here?
Yeah, because you're right on the edge.
Okay. So he could run it like both ways then.
Yep.
Yeah.
They could do a bunch of different what ifs for you.
So Scott, he's got $80,000 in after tax in his.
How are those
would you say 403Bs and 401Ks?
Yeah,
Wait a minute.
457 or
You've got
after tax is 457 and Roth.
Oh, so your after-tax dollars you're talking about, these aren't monies that are set aside in a brokerage account or in a savings account. These are after-tax contributions that you made over time to your retirement plans. Is that correct?
In addition to the money, the $36,000 you have in the IRA, right?
Yeah, that's correct.
Why did you make so many contributions on an after-tax basis?
I don't know. I just thought it'd be important to have some after tax at retirement for larger purchases.
Are those after tax dollars with your employer's plan, or were these after tax dollars that you had saved elsewhere?
Some are with the employer's plan, and then some's just a Roth IRA that I opened up with Vanguard.
Got it.
How much of the $80,000 in after taxes with the employer plans?
About 15,000.
Okay.
Okay, so it's not much at all.
Yeah, okay.
I was sitting that
that's why I
is
dialed
if
in on
80
that.
grand, I'm going to say we need to figure out how to get that to a Roth. We need to devise the strategy, seeing how we can, whatever you need to do with your employer's plan, which may or may not have been able to do, but
that's why I dug into that 80,000 was to try to determine. And the reason behind that, if you could take those after-tax dollars in your employer's plan and direct them to a Roth, then the growth on it occurs on a tax-free basis. Inside the plans, they do not.
yes, it's gross tax deferred. But let's say you had $10,000 of after-tax contributions to your 401k that grew to $15,000. That $5,000 of growth will one day be taxed. If that $5,000 occurred within this is exciting radio, by the way. If that $5,000 was incurred inside a Roth, it would be tax-free as long as you waited to retirement, et cetera. But
okay. the moral of the story is don't put any more money after tax until you fund all your Roths that are available to you.
Okay. And that we've been doing that.
Okay.
Yeah.
Yeah, that kind of spiked out to me when you said 80,000 out of the 400, but it makes sense the way you're doing it. You're fine.
So I think your question is how much should you have, and I really look at it as like pre-tax dollars versus after-tax dollars, right? So in a perfect world, you're at retirement and all your money is tax-free.
In a perfect world.
But it's not a perfect world. So the way the tax structures work and whatnot, most people, it makes sense to take or for many people, it makes sense to take a pre-tax contribution to take that deduction when you put money into your company's retirement plan. And at the tax rate you're at right now, it sounds to me like you're probably best off continuing to put money on a pre-tax basis.
And don't worry about putting money in an after-tax other than funding the Roth IRAs.
Okay.
All righty?
Yeah, and I think our income level next year, we won't be able to do the Roth. We won't qualify.
I
guess we could do the back door.
Yes.
Well, it's depending if you have other IRAs.
Yeah, which would be one of the reasons that you might want to convert this $36,000 in the IRA to a Roth IRA.
Okay.
To provide that going forward. I would agree with that.
Because what happens is on a regular IRA, if you do a backdoor Roth, right, and you put a non-deductible IRA contribution, then you convert it to a Roth, they look at all your IRAs, and then the conversion goes on a pro rata basis. So if you have no money in regular IRAs and all your money in Roth IRAs, then you could use what we call the backdoor Roth going forward, which might be one of the driving factors to convert this IRA to a Roth IRA. In fact, I would vote for that if anyone was counting my vote, or if they were lost in transition or whatever.
Stolen or something.
Something. All righty, John, thanks for the call.
It's interesting, Pat. Kind of joking, make obviously a reference to the election, but It's what's interesting right now is here we are in December of 2020, and we're all doing a bit of tax. Well, not all. Some of us are doing some year-end tax planning, thinking about how to best minimize our taxes, and we're at a time that we're not sure what the political balance is going to be in 2021 and how that could impact taxes, because we know that what Biden, who is our president-elect,
yes,
even though that not everybody states that, yeah, it's clear, he will be our next president, very clear. He has stated what he would like to see with taxes, which would be an increase in income taxes and a dramatic increase in capital gain taxes and an increase in corporate taxes. The Republicans have stated they don't want to see any increases in taxes. Right now, we're going to have Biden's going to be a president. We're going to have Congress that's going to be majority Democrat. But we've got right now, as everybody knows, a Senate that is
up in the air.
It's going to come down to a runoff in January between two people in Atlanta. In Georgia. And so, when you look at this, it's like if both Republicans lose and two Democrats get in, and the Senate is 50% Democrat, 50% Republican, with the tie going to the vice president, Democrat. So the Democrats technically would have the majority to push through some taxes. May not have the political capital to do so, because there's probably a couple that aren't as excited about that and might be afraid that they would be kicked out of the office in 2 years if they voted for something. On the other hand, if at least one Republican wins, it'd be pretty clear there's not going to be major tax increases next year.
Yes, which is hard to plan around. Had a conversation with a client this week about that very thing. And sometimes when you don't know, you just split the difference. Right? So the discussion we had was, do you recognize capital gains this year or not?
Whether it's capital gains, whether it's Roth conversions, whether it's deferring the sale of something until next year.
Whether it's your gifting strategy
gifting
out
too.
of your
Taxes
estate.
are going to be higher next year. Maybe better to gift next year instead of this year.
Yes. No one knows. All I do know is that if I was a radio station or a television station or some sort of advertising medium in the state of Georgia, I'd be pretty happy right now.
I was going to say, where are you going with this?
Wouldn't you? The money's just flowing.
Well, and I think, I'm not an expert here, but they have to charge like a rack rate for everybody, right? So it's like...
well, at least historically they did. I don't know if they have to now, but historically they had to charge everyone basically
the same rate, right? Otherwise, they're playing political favorites. And so historically, I know that the radio stations have really enjoyed the political seasons. And
yes, yeah. So it's you got that going for you, Georgia. People are putting money into these runoffs that can't even spell the name of the people running for office. That is just flocking.
Well, because a lot of it's obviously we all know what it's going to. But we look at things from a financial planning professionally. We look at things from a financial planning standpoint, and the major implications here is like, what is that going to mean to us going forward? So,
what does that mean to our clients?
Yes, and the listeners here. So there is some chance that there will be a tax increase next year. What chance is that? And that's where you kind of come up with some sort of probability. As with any sort of looking at any sort of investments or future cash flow, you look at probabilities because nothing's 100% for certain.
Yes.
So what's the probability of there being a tax increase there? And if you're like an engineer type and want to try to do everything mathematically, apply some factor to that and use it in your calculations.
Yeah, there is. Speaking of that, we've talked about Social Security. If you've listened to this show for any period of time, you know our theory about Social Security, which is if you don't need it, you should probably take it as early as possible. But if you need it to live on, you probably should defer.
Till age 70.
To age 70. I saw a proposal this week where it was going to be, they were recommending a flat Social Security number for everyone. Everyone.
What do you mean?
Well, now it's if I earn $200,000 a year, versus $20,000 a year.
What about if you're connected politically? Do you get a little more then, like in other socialist regimes?
But that's, and I thought, well, that's interesting because I never thought about it that way. I always thought about how they'd just take it off from the top and leave the lower ones alone.
So it has nothing to do with you.
Nothing.
I hadn't seen that
Zero.
proposal.
I saw it this week and I thought, that's interesting. I never thought of it that way. I expect that at some point in the future, people with high net worths or high incomes will lose Social Security benefits because they can. And it won't affect their standard of living. Where that line is drawn, I don't know.
Or if it just gets...
Or if you just say everyone gets $1,500 a month. Right? Or if you retire at 62 or at 65, you get $1,600 a month, regardless.
It'll be interesting to see where this all shakes up. It's coming. That train is coming.
Oh,
in the next decade, we have to face it.
I wouldn't be surprised if we didn't see a change in Social Security benefits in the next 4 years, especially if the Democrats take this.
Well, they didn't have the mandate. They didn't have the mandate that they thought they were going to have a few weeks back. Anyway, we're taking a quick break. When we stick around for more of Allworth Financial's Money Matters with Scott Hansen and Pat McClain.
Can't get enough of Allworth's Money Matters? Visit allworthfinancial.com/radio to listen to the Money Matters podcast.
Welcome back to Allworth's Money Matters. Scott Hansen.
Pat McClain.
Let's take some calls here. And if you want to be part of our program, we always enjoyed... Actually, I think my favorite part of doing this program is talking to our people, our listeners who call in and ask us questions, because every question's a little bit different, and everyone's different, and I just find it interesting.
Yes.
And helpful for you. 833-99-WORTH is the number. We're talking with Daniel. Daniel, you're with Allworth's Money Matters.
Hey, guys.
Hi, Daniel.
What can we do for you?
Okay. So I've actually spoken to you guys probably about 6 months back about some financial planning, and I made a move, and now I'm in a unique situation, so I want to get your advice on this.
All right. Fire away.
Okay. So essentially, we moved out of a property that we used to reside at, and it's now a rental. I'm living with in-laws because we want to transition and move to about 30 miles away. Our life is bringing us out in that direction, basically. We have this rental that's worth about $450,000 over the loan amount that we still own on it.
Wait. So you have $450 in equity in it, is what you said. What's the value of the home?
I'm going to estimate right about $650. I could possibly get $7 out of it.
Okay, and how long have you owned it?
Since 2013.
And what did you pay for it?
$265, and there's $200 left on the loan.
And was this your primary residence that you just converted to rental?
Exactly. Yes.
Okay.
Okay.
All right.
Yeah, I got you.
So right now we're basically out of a home. We're just renting from my in-laws. They have enough rooms to accommodate me and my family. And we have enough for a down payment on another home, but we're kind of torn in between selling this home because of the equity line that we have, and just, putting a traditional down payment down and still having a lot more to play with, or keeping this rental as it stands and just putting a down payment on a home where we want to move to.
If it were me,
looking at it,
I would sell even if I wanted to keep a rental, I would sell the house that was your primary residence.
Why, Scott?
Because of the free capital gains that you can take advantage of. Because as a couple, you can avoid up to $500,000 worth of gain with you pay zero income taxes on.
So what you
and
did...
if you convert this to rental and leave it, 2 out of 5 years, there was a recent change, though. Now they've made it's not as clean as it used to be. But if you, after 2 years from now, you'll lose it's either 2 or 3 years, 2 years, I believe. You'll lose your ability to sell this as a primary residence.
So what that means, right? So there's two decision points that you go through. One is, look, would I buy this home today and convert it to a rental? Forget that you ever owned it. Ask yourself that question seriously, which is this the most efficient home rental that I would get? So in order to be efficient home rentals, you want something of under that isn't too old, that doesn't have a swimming pool.
Not a lot of yard maintenance.
Not a lot of yard maintenance, normally stucco, dual pane windows, hopefully less than 20 years old.
Linoleum floors.
Yes, right. So that's the first that's the first question. The second question is, what are the long-term tax ramifications to this? So let's say that you wanted a rental, that you decided this was the rental for you. You would be better off selling this home and buying the exact same home next door for tax purposes.
That's right. Because you've got about $80,000, you have $400,000 of gain. Let's figure 25% combined federal and state. That's $80,000. So you have somewhere between $70,000 and $80,000 of capital gain that you would pay if this were not your primary residence.
But because it was your primary residence and you converted it to a rental, that makes it that it changes the tax.
So what's the new house going to cost you? You're moving 30 miles out. What will a new house cost?
We are moving to a more expensive area, and it is we're going to estimate in summertime, if there is a drop, or let's just assume there's a little drop, it's probably going to be about a $550,000 home for about the same size. And what you
I
guys
thought you said your home was worth
add,
$650. That it sounds like it's less expensive, not more expensive.
Oh yeah, I apologize. If we're assuming, because I'm going into probably a smaller home, smaller size,
home.
and but because this, I wanted to add, because what you guys just said was important, is this home that we're renting out does have a swimming pool, it has a spa, and it has a pond that is.
Forget it.
Too much maintenance.
Just forget it. And it's on 2
and it's
acres.
a big yard. It's about a 6,000 square foot yard.
Yeah. It's a terrible rental.
Yes. So if it makes sense to have a rental, I wouldn't have that one.
That one. I wouldn't get a rental with a swimming pool. Just flat out.
So a new house going to cost you $550. How old are you?
39.
How many kids do you have?
3.
And does your wife work outside the home?
No, she's a stay-at-home mom, but currently going to school. That's why part of the reason why we want to move closer is her school, the commute and stuff.
What's your approximate family income?
Right now, $80,000 a year.
Oh, I'd sell this thing and put as much cash into the new house as possible. First of all, I'd sell it because it's a terrible rental and the capital gains.
What's your wife in school for?
Dental hygiene.
She'll make
what do you have
about a year and a half.
What do you have in retirement savings?
Retirement, about $140,000.
If you were my younger brother, I would say
much younger.
I would say, look, sell. Like the house that you lived in makes a terrible rental. Then the question is now the right time to buy a rental for your situation? You've got 3 kids. Your wife's in school, so she can have a
terrible
career.
Time.
So in a couple of years from now, cash flow is going to be pretty good coming through the house.
How much money do you have in savings?
Savings, not too much, just pretty much a down payment, probably about $30,000.
All right. So I'd do is I'd sell this house. I'd keep $50,000 in cash, and I'd
the smallest mortgage possible,
and get the smallest mortgage possible, and I'd roll it over, and I'd get a 30-year fixed rate mortgage.
Okay. What about also, because I would probably have enough to put in basically two traditional down payments and have another rental somewhere else.
Oh,
is that suggested?
I don't know if I'd make that move at $80,000 a year with 3 kids and a wife at school.
Okay.
Your responsibility is to your family.
It's that you've got. I mean, what you're talking about is levering up, right? It's taking on more debt. You'd have quite a bit of debt on a rental. What happens when the renter doesn't pay for several months? Those things happen, right? I mean, I've owned rentals, still own rentals.
Yes. What happens if there's repairs, significant repairs? You're just not at that space yet.
Okay.
Right? So build a wall around your family first. Build the wall. Make sure that you've got at least $1 million of term life insurance. Fund the kids' 529s if that's appropriate before you actually start moving into the rental sphere.
And home prices are not cheap right now.
Oh, it's the yields, the cap rates on these things are relatively low.
Relatively. like historically. I mean, like.
Yeah, we would wait till summer, I think, just
Well-
because I think that there's a better possibility of more, the mortgages going down.
I don't.
Oh,
I'm not that. I don't think that
If
the
I were
interest
in your
rates are
position,
going to
I
go.
would not wait. I would sell that house. I would get the cash. I'd find my new house because it's anyone's guess where the markets are going to go over the short term.
And I agree with Scott. Just make the move.
And look, I mean, here's the beautiful thing. You got 3 kids still in the home. If you think out your future about building some financial stability for you, having a very small mortgage on your house, that is financial stability. And the whole concept of unleashing the equity or that sort of thing, I think it's a bunch of nonsense. All people are talking about doing is borrowing against your house, the thing that you live in, that you have your roof over your head.
Your castle. I mean, build the wall around your family, then get rich.
Yeah, and your
Yeah,
wife's
no,
back in
I
school.
don't-
Your income situation can be much different 2 years from now.
I'd list that house today.
I would too.
Wow. Okay.
I'd make sure the pool was
We've
clean
been thinking
first.
about it.
Yeah, I mean, we don't know what's going to happen, but we've seen enough market cycles. I've seen enough things. I mean, if this whole COVID thing hasn't been strange enough, who knows what?
I
what
have
else
a
can happen.
relative that has a house in San Francisco. Young man, 30. Same question. What do I do with this? I'm like, that's a terrible rental. Sell it as quickly as possible. Unfortunately, he didn't sell it before the pandemic.
San Francisco, they rents are
Oh.
down 20%.
Yes, correct.
Apartment rents
Yeah.
anyway.
Yeah.
Latest apartment rents.
Yep. So sell it, list it as quickly as possible. Buy your new house as quickly as possible. Your in-laws will thank you.
All right, that's our opinion, Daniel.
All right, appreciate the call.
Yeah, glad you called. And so San Francisco, is he trying to sell it? Is it in the city?
Yeah, it's in the
So
city
he owns some house in San Francisco
that he was living in.
probably worth $1.5 million.
He was going to convert it to a rental. I explained the whole process, just like we just did
Right.
with Daniel about the capital gains and the fact that it would make a terrible rental. I said, if you want rentals, go to suburbia, buy a house that is not 48 years old, buy something less than 20 years old, stucco, small yard, buy 2 or 3 of them. You're much better off doing that than you are holding a house. And he said, well, the appreciation.
In one of those neighborhoods, look, suburbia, one of those neighborhoods with 0 lot lines or whatever they call it, where there's like the tiniest gardening as
where
possible.
every house looks almost identical.
Yes, those are the best rentals.
Those are the best rentals.
Maybe something that's been built in the last decade. Appliances are new.
Yes.
Nothing to worry about.
Up to code.
All that stuff, yeah. 833-99-WORTH is the number if you want to be part of Allworth. I almost said Handsome McLean's because
Well, we used
that
to
was
be.
our previous name until we rebranded. And I still get questions. Someone's asked me, what's it like working for Allworth now? You still working for Allworth? And I said, you do realize that it's the same company that Pat McLean and I started 20-some years ago. We just rebranded. We tried to change the name, upgraded the name to Allworth Financial, and we've merged in with some other partners. But it's the same company.
Yes. You tell him
right.
to never bring it up again?
I said, I don't want to be your friend anymore. That's essentially. And then it reminded me I have very few friends. Okay. All right, let's, we're going to talk with Jeff. Jeff, you're with Allworth's Money Matters.
Hi there. Thank you. It's an honor to be able to have your attention for a few minutes here
thank
to
you.
talk about my situation. So
Wow,
thank you.
I get that at home all the time. My 20-year-old.
Dad, it's an honor you came home tonight.
My
after-
20-year-old was telling me that this morning.
So I'm a 63-year-old single guy. I'm mostly retired. I've had my own consulting business, and I've pretty much passed it on to my son, but I still dibble and dabble a little bit to help people. My issue is I've been a saver all my life. I can remember back when I was 10, 12 years old, or 12, 14 years old, having one of those little passbook savings.
Yep.
Yep. I had one at Guild Savings.
You sit there, and you look at it and you do that, and I even like charted how much money it was growing.
Remember,
you know,
they'd write in the number in that little passbook, and then
Yeah.
they'd put a stamp next
That's
to
right.
it.
That's right. A little red stamp
Yeah.
with a date on it.
Yeah. Down at
that
Guild
too.
Savings. I ride
I
my
forget
bike
the
down
name of
there, deposit
All right. It's not
$22.
about, this is about Jeff, not
Oh,
Pat.
sorry. Okay. All right, Jeff.
Memory lane. Yes, that happens at old age. Anyways, so I am now somewhat retired, and I've got this issue where I've got money and I don't know how to spend it.
How much do you have?
Well, it's if you took a look at the retirement accounts and the value of one of my rentals, I have about $1 million plus.
And how much money did you earn on an annual basis when you were working full time?
When I was working, I earned probably around 60 to 70,000.
And where's your income coming from today?
Today, it's coming from my state retirement, Social Security, and then the rental, and that comes out to be around $6,000 a month.
And you're doing consulting. I assume your home is. I assume your home is fully paid for.
Oh, of course.
Okay.
And your question is, I've been a big saver. I'm saving for the future. At what point has the future arrived? And then what am I supposed? Then what? Is that what you're like?
Right. I mean, there's been plenty of callers who talk about, oh, I've got time. Oh my gosh, what do I do with all this time that I have? Mine is a little I can figure out what to do with my time as far as volunteering and groups I belong to and meet people and have a good time. But it's the spending money. I mean, I
wouldn't change a
I had to go meet somebody today, and I took my own cup of coffee when we met at Starbucks. I mean,
okay, well that's
well, you know what? I wouldn't worry.
Wait, how did Starbucks feel about you bringing in your own product?
Well, it was in one of their cups, so
Okay.
I already paid for it, you might say.
I wouldn't change a thing.
If you were to do anything, I would say, if you earmarked even just start with a small portion of this to one of the organizations that you're involved in, some nonprofit, and give a little there and
That
see
would
what
help.
that feels like. If that's you're gonna give it eventually.
You're going to give it to your kids, you're going to give it to the government, or you're going to give it to
Well, no, that's
a
what I'm
charity.
saying is I want to spend it, but I don't know how.
Oh,
Oh, then
got
wait,
it.
I'm
Oh,
not gonna
got
give
it. Got
to
it.
the kids,
Got
but
it. Got it.
I got nothing from the parents. You know, the parents gave me
So then
basically a funeral, and that was it. And that was.
But that's on the assumption that more spending is going to bring you more joy and happiness.
Well, it's not so much the joy and happiness as I've never had this mentality of spending money.
Yeah.
And I'm trying to figure out if you know people like. You know,
Oh yeah, they are our best clients. Are you kidding me?
There are therapists that will help you with compulsive spending. Are there therapists for compulsive saving?
That's a great question.
I would imagine a typical therapist could help if that.
That's one way to
If-
actually
if-
spend it is
here's-
to go to a therapist.
$150 a week, it's going to go pretty quick.
I was waiting for you to say get a wife. You know, that'll help you spend your money.
Some, fortunately not mine. So there's two things to do. I like Scott's, or one of the things you can do is to start up an automatic distribution into your checking account. I do this for many of my clients, and we'll
right.
start 1,000, 2,000 for you. Just start with $500 that goes into your checking account every month automatically, coming either from a brokerage account or your IRA, depending upon your margin of tax rate.
However you budget things, have an extra $500 come through.
And don't stop it. And you'll find yourself actually being able to spend that because it's showing up there and you know that it's systematic. And just do that.
And tell
for
yourself
12
you can't
months.
put it back in
and
savings.
you can't put it back in savings.
It's got to go somewhere. Either spend it on yourself or give it somewhere. Or
I had a client who has a husband and wife that are since deceased 25, 30 years ago, that I would send money to him on a monthly basis. And every 6 months, he would bring the same amount that I sent to him out of his own accounts and deposit it back into his account. And this was when I was young in my career. And after a year and a half of this, I told him I would no longer take any new deposits into his account from him. And he asked me why. And I said, well, that was designed to be spent. And he said, well, what do we do? And I said, well, you and your wife like Indian food. I'd like you to go out to lunch twice a week now. And it changed the behavior because I wouldn't allow him to return the dollars into it. And I'm going to recommend exactly the same thing to you. Have the $500 a month go into your account, spend it, and start with that.
All right.
yeah,
All right.
just starting something, you'll feel good about it.
All right?
Or bad about it, or a combination. So.
And listen, by the way, it was an honor speaking with you.
Oh, of course. So thank you.
Thanks, Jeff.
I appreciate it.
Yeah, it's the irony is, I was kind of joking there, but you asked, are there more people like that? They're our best clients. I mean, the irony is that Well, first of all, some of us are just born savers and some of us are born spenders. If you have multiple kids, you see the differences between the kids, and it's just some of it is just kind of innate. But
my kids are born savers, but they're when it comes to spending, as long as it's mine, they're pretty good at it. My son is driving back to L.A. today, and naturally they had to go to the Costco yesterday with his mother. And I'm like, wow, how's that work?
yeah, whatever. I mean,
Right.
what mom doesn't like making sure their kids are well fed? I mean, that's like the most basic right there. Make sure my kid has enough food.
Yes.
Right. So, all right. Let's continue on here. We're in Cincinnati talking with William. William, you're with Allworth's Money Matters.
Thank you for taking my call. I have a situation where I have about $160,000 in a IRA. I am retired, taking a disbursement of my Social Security early because I am a cancer survivor, and it's $1,900 a month.
How old are you?
And I'm 67, and I am doing a side job where I'm pulling in $700 to $1,000 a week. I have no interest in sitting and doing nothing. I have over $20,000 in a checking account, which I want to take half of that. And that's my question. What should I do? Because I fully funded my IRA for $2,000. The question should be, should I continue to fund that because of the deferred taxation, or should I put the money towards something else? Now, I do have a $40,000 invested in a annuity that is controlled by the Standard & Poor's and so forth. It's not managed. It has unlimited potential to grow if it does grow, and there's no cap.
Okay.
I also am looking at what do I do instead of sitting there with $20,000 in my checking account, which earns
Nothing. Yeah.
0.001%.
Are you single or married?
I am single, but the assets will go to my former wife. But they're also destined to go on to my grandkids, which I'm fully funding their $2,000 a year for an education fund. I have 3 of them.
And if I can get a little more personal, what do you think your life expectancy is?
Due to the cancer, my goal is 75 to 80.
Okay.
And I assume you have no debt on your home?
I have 0 debt. I pay cash for my car.
And your home is paid for?
I rent. I pay $550 a month. I get $1,900 plus from Social Security, and I don't spend money. I heard the previous caller talk about how do you spend money. Well, you got to be able to get out and do things.
How old is that annuity? How long have you owned it?
I just bought into it last year.
Okay. I wouldn't buy any. My personal opinion.
Yeah, don't buy any more.
There is caps on it, and it's not unlimited.
Yeah, it's not good. And by the way, it doesn't have the preferential tax treatment like the S&P 500 would if you owned that.
I understand.
It doesn't receive a full step-up basis. But by the way, the person that sold that to you, don't talk to him anymore.
I hate it. I mean, I would I don't think $20,000 in liquid cash is too little.
I think you're fine.
I mean, if the check you want to put $10,000 somewhere, I'd go to bankrate.com and do an online bank and just do who's got the highest yielding savings account.
And you'll find someone like Synchrony or
I do have a non-qualified plan that has $20,000 in it.
What does that mean? What's a non-qualified
plan?
So
brokerage account.
Yeah.
I like the idea of cash. I like the idea of cash, steady cash, doesn't fluctuate. There's a health issue that happens to you. There's a health issue that happens to a loved one, your grandkids or something. You need cash. I like the idea of having some emergency cash. And $20,000
That's okay. Where did you buy this
not a
annuity?
ton.
I'm hung up on this annuity. Where'd you buy the annuity?
Well, the structure of it is if it's managed, there's a fee and a cap.
Understand?
If
It's an index annuity.
Yeah, and if I guess that's what it is.
Yeah.
But if I just let it ride, Standard & Poor's 500, there is no
That's right.
cap.
So it's
on
just
what it can earn.
it's an index fund. Where did you buy it? Did you buy it at the bank?
Through a financial services national company.
Okay.
Yeah.
Yeah. But you don't buy any more of that. I think you're fine. I would just make sure that your portfolio is well diversified. The IRA, I think $20,000 in the bank is fine. I agree with Scott.
I wouldn't look. It's easy to say. I need you. You want to. Anytime you move out of the bank and go to somewhere else, you are taking on more risk. And the question is that risk going to be? Is it worth it given what a chance of an income need? And if you were talking about $200,000 sitting somewhere, well, that would be ridiculous, obviously. But given the income level you're at, I do not think that $20,000 in cash equivalents is too much at all. And so that would be our recommendation, to keep it in those cash equivalents. And appreciate the call, William. And further, there are limits on that. There's no such thing as a free lunch. So if someone's telling you you've got the guarantee, you're going to get 100% of the increase, go read the contract.
It's an index annuity.
Go read. We're not big fans of those, by the way. Go read the contract. It's
Actually,
not
I think
such a thing.
I would venture to say we dislike them greatly because of exactly this. He
doesn't
can
understand.
take he can take more risk than an index annuity. He's not spending the money he has, and had he bought an S&P 500 fund, it grows pretty much tax deferred, gets a full step up in basis at death.
Much better tax for
He
us.
takes the money out, it's capital gains rates, and then annuity, none of that happens other than the tax deferral.
Yeah, we're getting short on time. I want to let you know of a couple good articles we've got at allworthfinancial.com. One is it's about updating beneficiaries. And I've been in this industry long enough to see what happens when people don't update beneficiaries, and it's not good if you pass away. But also there's another one, year-end tax reminders for a COVID world. So this is good. Anyway, as we're getting near the end of the year, on our website, there's an article that'll deal with some of the major tax things to be considering and some of the changes that have occurred as a result of some of the COVID packages that were pushed through earlier in the year. So, again, that's at allworthfinancial.com.
And Scott, I would recommend if you have a couple, the article about beneficiaries is called "Have a Few Spare Minutes." Be sure to do this. You wrote it. I actually read it. I enjoyed the story that you told about the client.
Okay. All right. We're out of time. We'll see you next week. This has been Allworth's Money Matters.
This program has been brought to you by Allworth Financial, a registered investment advisory firm. Any ideas presented during this program are not intended to provide specific financial advice. You should consult your own financial advisor, tax consultant, or estate planning attorney to conduct your own due diligence.